All right, this is Tim Paskin here with Tim and Ryan, we're real estate experts. So you're probably wondering why you're getting this video. So you're probably getting this video because we sent you a letter talking about a variety of strategies to help mitigate a pretty big capital gains hit that you'd be looking at if you sell your property in California. Well, one of the strategies that we talked about, we work with some premier lawyers, Mark Kohler and his team. And we want to kind of just give you a little more exposure of what that strategy looks like. And rather getting it filtered through me and Ryan, you can hear it straight from one of the experts in the field. So with that, I'd like to introduce Mark. Mark, thanks so much for taking the time. Would you mind just telling us a little bit about your firm, some of the niches, the main areas that you guys specialize in, and just some of the types of clientele that you regularly work with?
Yeah, you bet. And Ryan, Tim, thanks for having me. This is awesome. I think many of you that are watching this, please give this a chance. We'll get right to the point here shortly, and you're going to love this content. I thought they were watching it, Tim, because they're nerds. Nerds rule the world. And so anybody that wants to save money and learn a cool tax strategy, you're a nerd in my book. So I want to make sure all of you feel welcome, because I love saving money and win-win-win, screw the IRS. So sign me up. So anyway, thanks for having me. So I'm a CPA and an attorney, a senior partner in an accounting firm and a law firm. We help clients all over the country, been in business 20 plus years. We have offices in California, Phoenix, Idaho, and Utah. I should say Arizona, if I'm going to refer to the states: Arizona, California, Idaho, and Utah. I'm out of Phoenix, Arizona, come back to Idaho to meet with the team and get my mojo back here in the country on a regular basis. But I have a YouTube studio. I shoot video. I've got some books here. I guess there's some books here on the wall. You can easily Google me, any of you folks that would like to kind of find out a little bit more about my credentials. I've got several books on Amazon, and I just love American dream, small business. This is Main Street America, baby. And that's where I love to operate. We've got 15 attorneys, probably 20 CPAs, well over 100 staff doing tax returns, setting up entities, asset protection, estate planning. We're lovers, not fighters. You won't see us going to court. Our job is to keep you out of court and protect your assets. And we're affordable. You can a la carte us per hour. Our flat fees are very, very reasonable. So we want you to come back time and time again and not feel like you got ripped off at a Hampton Inn this weekend. So that's us. 4 kids, living the dream. Woo! So thanks for having me, guys, again.
Oh, thanks for coming, Mark. So let's get right to it. Obviously, particularly in California, and particularly in Silicon Valley, one of the biggest deterrents that we typically encounter, one of the biggest issues that the folks we talk to have, they're ready to sell, but the thing that says, hey, you know what, I'm just not comfortable doing it, or I just can't do it, is the capital gains hit that they're looking at. Now,
what, they don't want to pay? They don't want to pay a buttload in taxes, so they're
no. They don't know where the money goes. I mean, every day they're dodging potholes, and like, we have the highest tax rate in the nation. Where does that money go?
Yeah, and why do a 1031? It's like, now I just traded one real estate mess for another one. Sometimes people love that game plan. I know you guys certainly know your 1031s, but I guess some of those people are like, I don't want an installment sale or a 1031. Is there anything else out there?
And some people, particularly in California, given just how much the balance is tilted towards tenant rights, vice landlord rights, are just like, hey, we want to get off of this treadmill. Yeah. So what I always tell them is, hey, the fact that you're looking at a huge capital gains bill, the bright side of that is it's a good problem to have. It means that your property has appreciated an extreme amount. And obviously, particularly in Silicon Valley, we tend to see about double historically the rate of appreciation of the rest of the country, but that's been even more significant, the last, really, since 2014. So it's not uncommon that the folks we talk to bought a property for several $100,000, maybe 20, 30 years ago, and now that property is several $1 million. So if they sell that, the conversation we have is, hey, you're looking at 20% federal capital gains, 3.8% Obamacare, and 13.3% state capital gains. They're looking at upwards of 35, close to 40% capital gains. And just a lot of folks are just morally opposed to paying the government that much money after working this hard for so much of their life. So obviously you mentioned the 1031 exchange. If they're willing to stay in the landlord game, there's absolutely areas that they can take that money, including a lot of the areas where you live and you have your offices, where they're going to get a much better yield on that. But most of the folks we talk to just want to get out of the business of landlording and just slow down and smell the roses. So what is the best option, in your opinion, for folks like that?
Ooh, ouch, ouch. I like it. The best option. You were doing so well until you said that qualifier, best. Well, what I think is the best is what fits your client's needs. You know, we might be able to split up a transaction, do part 1031, part sale of home exemption, part charitable trust, part opportunity zone, part installment sale. So now that would be a very complex transaction, but the point is, I want your clients to get what fits them the best, and not what is the best strategy in totality, but what's best for that client. I know that's what you meant, but so let's talk about the CRUT, the charitable remainder unit trust. And as we get closer, I'll lay out how these work, so all of you can do your homework you're watching this video. I want you to feel very comfortable with this. I'm a lawyer of a reputable firm. Go ahead and Google. We want to be in business for another 50 years. So we're not going to be teaching anything out there at a strip mall and, getting in trouble. So we carry all the normal malpractice insurance policies and members of the National Bar and ABI, CPA, all the different organizations. So you can do your research on us. So this is very legit. Take comfort in this strategy. Gosh darn it. Warren Buffett and Bill Gates got together on a charitable trust a few years ago, the Bill and Marion Gates Foundation. So this is a very common strategy. Entire schools and churches and charitable organizations have teams of lawyers helping people execute these trusts. Now, all right, are you going to give away all your stuff to charity tomorrow? Hell no. You're going to love this result. So I'm going to, if it's okay, Ryan and Tim, I'm going to go over to a whiteboard and maybe we can just go through the steps of a CRUT, and then you guys can, unpack it with me and ask me some questions that you think would be typical questions of your clients.
Sounds like a plan.
Okay. All right. So I'm going to jump over here and share my screen. Let's get a whiteboard going here. There's probably about 10 steps in this process, folks. So be patient as we kind of go through this. And I think you're going to love it. So now, Corey, I'm trying to, what I want to do is go over to notes. Here we go. All right. You guys see this all right? Tim, Ryan? Okay. So step one is we need to create this CRT. Now, there's probably 20 to 30 variations of charitable trusts out there. Let me get this up a little higher. There we go. There's about 20 to 30 variations. The one that I find resonates the most with my clients, and I love it, and it's the kind I would use myself personally, is a CRUT, charitable remainder unit trust. There's CRATs, charitable remainder annuity trusts, where you get a fixed payment for the rest of your life, but there's a lot of strings with that fixed payment. I think you're going to like the CRUT. So be open to that for a moment. And I've got videos on YouTube where I break down the differences between the two, but I wanted to cut right to the chase. Tim and Ryan are like, don't waste our clients' time. Let's get right to the good stuff. So what I prefer is a CRUT, C-R-U-T. Now I'll explain what the unit trust really is all about. Now, step one in this process is you got to create the trust. This could be terrible news to some of you, but I'm going to say it. If you've already got a property under contract, you've already sold a property, it's too late. You've got to get engaged with Tim and Ryan right away to get the CRUT going before you do the listing and sign your REPSI, real estate purchase contract. Now, if you're in process on a transaction and you want to unwind it to do a CRUT, you would need to talk with these guys, and they're going to help work with the buyer and say, hey, we need to redo this entire transaction. Can we unwind it? And protects everybody's interest so that no one feels like they're getting the deal pulled out from under them. But I just have to reemphasize, if you're already halfway down the road on a real estate transaction, the CRUT may not work, and you got to get with your buyers and your agents to help you unravel that and start over. So step one is a CRUT. Now, this is a trust document. It's not filed with the state. It's not filed with the IRS. It's going to get its own tax ID number, its own bank account, and you, the grantor, can also be the trustee. So you'll be in, you don't have to go pay someone thousands of dollars a year to be your trustee, and they're not going to take over your money and control it unless you choose to bring a financial advisor into the mix. So hang tight again. I'm not trying to sell you my financial products or services. So I'll tell you how much the CRUT costs here in a bit, and you guys can say, oh, that's, great deal, or we're going to shop around, whatever. So step one is you got to create the CRUT. Now, an interesting piece about this CRUT is there's going to be two beneficiaries. There's going to be an income beneficiary. Forgive my handwriting here sometimes. Okay, there's income Benny, and you're going to have a residual beneficiary, or I'll just put it residual beneficiary. Now, why this qualifies as a charitable trust is because we're going to give this corpus, whatever's left in the trust, when you die. Now, if you're married, it could be on the second to die strategy. So there's two of you, and at the second death, or one of you, your death, whatever's left in the trust is going to go to a 501c3. Now, you can even set up your own private foundation. You can say, I want to set up my own trust, charitable recipient, and get my family 501c3 involved. And you can always add that later. You can always change your 501c3 beneficiary. Don't feel like if you choose the United Way today, you're stuck. You could choose Red Cross tomorrow. But you're going to have a residual beneficiary and an income beneficiary. And guess what? That's going to be you. And we're going to make sure that you have a pretty cool experience here as that income beneficiary. So we create the trust. We've got these designations. Step two is we're going to take the property that's maybe worth $2 million, let's just say. Man, if I hit my wrist on this pad, it kind of jacks up my pen. So if thanks everybody for your patience here, sometimes the writing's a little ugly. Okay, so step two, we need to transfer the property over to the trust. In fact, my arrow's messed up here. I don't want to have it. This is a work of art, so I want to make this look pretty here.
We're going to hang this in the Louvre. No worries.
That's right. Yeah. So the property goes into the trust, not out. So we want to transfer the property into the trust. We're going to transfer that in. All right. Got to get in my flow here. Transfer in. So now the property is in the CRUT. Now you may not even sold it yet. Now, typically the plan is to get it on the market right away and get it sold. You don't want to leave it in the trust too long. It can cause some problems. So we want to get this thing off to the races. But the moment you transfer this property into the CRUT, you get a tax deduction. I'm going to call that step three. The beauty of this is because in the future, it's going to go to a charity, you get a present value tax deduction for this wonderful gift you're going to give when you die, or the second of you to die. So this present value tax deduction is taken right now this year against any other income you might have. Now with a CRUT, it's going to be around a 10% deduction on the fair market value of what you donate. You may say, well, I'm donating the whole house. Why don't I get 100% freaking write-off? Well, because the charity doesn't get the money till this date in the future. And so we got to say, what is that deduction worth today? And so you get that deduction today. And if you don't use it all up this year, you write it off up to 5 years. Most of my clients chew it up within 2 years. So you're going to take this tax deduction on your personal return and based on the future donation to this charity. Now, step four is we've got to sell this property. And the beauty of this whole strategy is when you sell, there is no tax, no federal tax, no state tax, no Obamacare, no tax at all. Now, the beauty of that is that you're going to be able to take this 2 million and put it into your CRUT to get to work for you right away. And we'll talk about your options there. But I'm not going to take this 35% haircut of close to 700 grand. And who wants to write a check to the IRS for $700,000? It makes me want to throw up, right? So we can sell this with no tax, and all of those proceeds go down into the CRUT. So now the CRUT is sitting on $2 million. That's the beauty of this. Now, some people get mad when they go, well, Mark, you tell people it's a tax-free deal. Well, it's tax-free when you sell it. But these distributions you're going to get in the future, you'll pay tax on those, but we get a bigger bucket to play with. Now, here's how the distributions work. The step 5 is we have to calculate what is going to be your distribution rate. So let's say it's based on one life. So I've got a 55-year-old male. And by the way, I have IRS tables for this. So if you want to go know when you guys are going to die, I could look up in a table at the IRS and tell you. You may not want to know, but I can. So anyway, I look up in these actuarial tables and I got a 55-year-old male. Your life expectancy is X. And so the IRS says, well, we're going to let you pay out maybe about 11%. Now, don't hold me to this number. It varies based on sex and age, and it changes every year. If people quit living longer, it'd be easier. But anyways, you got this 11%, let's say hypothetically. So now this thing is going to pay out $220,000 a year for the rest of your life if this bucket stays at 2 million. So you're going to get this 11% kick out every year until you die. And we're going to talk about some other benefits here, but we run those numbers. Now, if I take a 55-year-old female, she's going to have a longer life expectancy. This distribution rate might be 10%. Now, it's important when we talk about this rate is I don't care what the rate of return is up in the CRT. I don't know what you're going to invest it in. You might start buying some cryptocurrency, which I love, and you might get a 15 to 20% rate of return. You could double your freaking Bitcoin. And we'll come to how that plays out here. But the point is, whatever your rate of return is in the CRUT doesn't matter. Every year, and let's open this can of worms, every year the CRUT is revalued on January 1st. And then your distribution rate kicks in, and that's your distribution for that year. So let's say and Ryan here looks a little younger than 55, but we'll play with Ryan. Here's the example. So, so if Ryan, it comes faster than you know, Ryan. So live large. Yeah, you never know. So anyway, Ryan gets his trust set up. He donates the property. We sell it. There's $2 million sitting in the CRUT. Well, his distribution rate, we'll say is 11%. We go back to a male, 55-year-old male, and that's 220 grand. So in the year we donate it, that would be his distribution per annum. So it'd be adjusted if it was mid-year. But come January 1st, 2023, we're going to revalue. So on January 1st, we say, okay, how much is the trust worth? Well, Ryan, he was pretty creative. He went out and bought some Litecoin and Ethereum and some Bitcoin. Maybe he went and bought some stock in General Foods or Microsoft, and oh my hell, it went up 20% in value. This thing rocked. Now on January 1st, the trust is worth 2.4 million because he did some good investments, and he gets to be in charge of the investments if you'd like. Some of you don't want to do that. We can talk about that option. But let's say on January 1st, it's worth 2.4 million. Well, what's 11% of 2.4 million? Oh, that's 11% times 2.4 million. It's 264,000. I got to use my Siri. This is why my phone is so helpful. So now in year 2023, it's 264,000. I'll write this up here. So in 2023, it goes up to 264,000. So the amount of the payment can change. The distribution rate does not. It's always going to be 11%, but every January, the trust is revalued. So you're highly incentivized to do good investments and build that bucket. And you did it without taking a 35% haircut with your taxes. So you've got this 2 million there. We revalue it January 1st. It's worth 2.4. Now for 2023, you get 264,000. 264,000 divided by 4. The answer is 66,000. You're going to get 66,000 every quarter out of this trust 4 times during the year. That's fixed. Then on 2024, we revalue again. And oh my gosh, it's worth 3 million. Or you had some bad investments, it's back to 2.2. Whatever the value is in January 1st, 2024, we do the math, we divide it by 4. There's your payments for that year. And your payments are fixed for that year while you go out and continue to invest. That's the beauty of the unit trust to me, is that you can continue to invest it and grow it and build it. And if you're wise and careful, you get a increased distribution amount based on a percentage. And also what's nice about the CRUT is if we made this a CRAT, an annuity trust, in order for the IRS to guarantee that you get that payment amount, that percentage on a 55-year-old male, I shouldn't say white male, just 50, it's kind of vernacular, right? But a 55-year-old male, that distribution rate on an annuity trust might be 8%. So the beauty of the CRUT is twofold. You get a higher percentage, and it's based on a revaluation every year, because IRS says you're taking the risk, that you're going to invest this thing and do wise with it. So the CRUT kicks out this distribution every quarter based on an annual valuation. That's step 5. Now, step 6, and I'm going to erase some of this over here so we can have some space here. Step 6 is an option. Not everybody does it. Some do, but I'm going to mention step 6 as a type, and this will help you out when you do it. If you do a consultation with my law firm and say, hey, I'm kind of interested, you can do that initial consult, and then we can move forward. You can ask some of these questions regarding your situation if you'd like. But option 6, I'm just hitting the highlights, folks. That's what I'm getting at here. I'm sure many of you already have questions, but option 6 is we're going to say, I'm going to buy some life insurance. I'm going to go out and buy $2 million worth of life insurance and use some of this distribution to pay for that premium. And it's going to be received by my family when I die, which is going to be step 8. We'll come back to that. My family is going to get this 2 million tax-free. And so 2 million tax-free to the family. And step 7 was the charity gets whatever's left. And if we do it right, they're going to get 2 million as well. Because what I want you to do is get an internal ROI every year that's greater than your distribution rate. So I want you to be smart and invest it properly. But if everything works well, you get this distribution the rest of your life. You have life insurance you can purchase if you want after the trust is done and sometimes we put that in what's called an ILIT, irrevocable life insurance trust. Some of you might hear that term out there. We can talk more about that. But this ILIT pays out tax-free to your family in the final step. Step 7, upon your death, the trustee gets their money and your family gets their money, both tax-free. Isn't this great? IRS, you know what? The IRS this is okay. This has been around for 50 years or more, the charitable trust. It's a wonderful thing. It's not going anywhere. And it's a wonderful benefit to the family and the charity. And it's just wonderful. Now, I said there was 2 options here. Another option we can build into the CRUT is we can do a 20-year guarantee that says, I want this money to come out for 20 years, even if I die in a car accident 2 years from now. So if I died in a car accident, back to Ryan as our donor here, if Ryan died in a car accident 2 years from now, the trust would keep paying out 18 more years. And then at 20 years, it would go to charity and done. But the life insurance would pay out immediately if he had the life insurance. But the annuity is going to continue for 20 years or your life, whichever is longer. Some people say, oh, I want the 20-year guarantee, but then it's over. Nope. It's 20 years or your life, whichever is longer. Now, in that situation, and we have to run the numbers, the IRS is going to go, whoa, whoa, whoa. We gave Ryan 11% because, he's kind of a dumb A. He's going to probably kill himself doing something crazy. I'm joking around with these guys, but so the IRS is going to go, we're only going to give Ryan a 7% or 6 or 8 or 9% rate of return, because if we got a guarantee we're going to pay this for 20 years, we got to make sure there's enough left for the charity. And so the actuarial tables and the calculations and tell us what that percentage would be under a 20-year guarantee. We can again go 2 lives, 1 life, 20-year guarantee, So there's so many variations. But the last thing that I just love about this trust, and it's not a step in it, but it's the overall benefit that this thing is asset protected. No one can get it in a lawsuit. So if you, heaven forbid, die if you, heaven forbid, get in a lawsuit, you're going to die. We just don't know when, unless the IRS tells you. But if you get in a lawsuit, they can't get at the $2 million sitting in that trust, completely asset protected from judgment creditors. And there's a spendthrift clause in the trust that says if a judgment creditor's going to get the money instead of you, we're not going to distribute. We'd rather give it to the charity than to give it to you, creditor. So that facilitates settlement and it keeps creditors away from the trust. So it's a wonderful benefit of getting a guaranteed distribution the rest of your life based on an annual valuation of a pot of gold that you get to decide on how it's invested without a huge haircut on the front end. And your family can still get money through a life insurance mechanism or a 20-year guarantee if something happened to you early on. and you get this charity that wants to throw a benefit dinner for you and name a wall or a building after you. So it's just really fun. And I guess those are the steps. I don't know if that kind of lays it out.
Well, thanks, Mark. Lot to unpack there. So a couple questions. So I'll give you, for instance, we just sold a house in Saratoga, original owner. The house sold for just over $4.3 million. The house was about 50 years old. Given the appreciation, obviously, that market has seen, let's just assume that almost that entire amount was profit, therefore capital gain. Okay. Same type of situation, older seller. I mean, given they're older, what I'm hearing is, that percentage from the actuarial tables could be quite a bit higher than, let's say, if Ryan or I were to sell the same property with the same amount of gain. Correct. So what we hear a lot of times is, it's great. I'm 75. I don't need $300,000, $400,000, $500,000, $600,000 a year. Are there any options to, I guess, bifurcate this, or is this all or nothing, the CRUD option, or can someone say, you know what, I just want to maybe mitigate some of my capital gains taxes? I mean, well, is there any way to nuance things for folks like this?
Yeah, and I kind of knew that's where you're going. I love it. And so I'm going to play artist here and do the best I can with our little bifurcation here. So here's our house. And what we're going to do, and this is an option, is, again, before the sales transaction begins, we can bifurcate. I love the word bifurcate. It's kind of, anybody you want to use that word, you'll sound really smart at your dinner party this weekend. Just use the word. Yeah, I bifurcated my home. Everybody's like, wow, that's a big word, so learn how to say it in Spanish even better. Okay. So
drink with your pinky out.
Yeah. You're going to split this property in two. And so we're going to have an A piece and a B piece, and we're going to create what's called a tenant in common interest. You may be owning your property right now in your revocable living trust. You might have it in an LLC. You might have it joint tenants with rights of survivorship. We're going to get rid of all those and just put a tick together, tenant in common interest, where you, the couple or the individual, owns 50% of this parcel, well, 50% of interest in the property, and you have another 50% interest. And by splitting it into two tenant in common interests, and we have also used an LLC structure where we might put the half that's going to go to the charity in an LLC. So, because how do you own yourself 50% and then yourself owns another 50%? So we got to create a little separation. So sometimes we'll use an LLC for that. But anyway, that's another conversation. So we create this tenant in common interest. This B portion, what we might do is take the B portion and put that in our CRUT. So we're going to put 2 million over here. Then the other 2 million you'd sell personally. Now, if this is your primary residence, we got all sorts of options, right? So this could go into, if it's your personal residence, we'd use your sale of home exemption of $250 or $500 if you're single or married. And if some of you are like, well, it's not our primary home, it's a second residence. Oh, well, maybe that's where we do a 1031. Or, oh, you want to do an opportunity zone and reinvest it in an op zone and defer some of the gain? Oh, okay. Oh, you just want to sell it and pay the tax and walk away? Okay, cool. Oh, you want to do an installment sale? Okay. So you got all these options, folks, for this other piece that because you want to get the money in a different format rather than drop it into the CRUT. So this would be a bifurcated strategy where we go over and do the CRUT like we just described up here, but you have this other half or percentage you choose to kind of do what fits your family the best.
Got it. Makes sense. So maybe my understanding here is the real benefit, or one of the big benefits of this, is you're keeping more money by saving on that initial huge tax hit. So we're talking federal capital gains, state capital gains, which are
crazy
impressive in California, 3.8% net investment tax, Obamacare, depreciation, recapture taxes. I guess those would probably be the big four.
Yeah.
At least if it's a rental property. Can you kind of break down that, the benefit of saving those taxes relative to the benefit of paying taxes, because there is still some tax payments that are going to be coming on those annual distributions.
Well, yeah. And so let's do this. Yeah. Let's talk about the two options from a numerical standpoint. And then what I'll throw out too is, let's maybe mention this now too, that if there's a lot of questions some of you are having, and here's how we work together, and it'll be a really, I think, easy and nice fit for many of you, is you can pay for a half hour with one of my lawyers, law clerks, law associates, and just say, here's my fact pattern from a law firm, unbiased perspective, answer these questions, tell me if I'm a good fit.
And then that's going to be holistic, vice generic, like this call. It's going to be tailored to their own needs and circumstances.
Yep. And so if you want to, Ryan and Tim will give you here my contact information. It'll probably be in your email, your description there of the video. Call my office, KQS Lawyers. Again, you don't have to meet us in person. If you want to come out to Phoenix or California or Idaho or Utah and come visit, that's fine. But we can get on a Zoom call or just a phone call and say, and discuss your concerns, your SPAC pattern, and find out if it's a good fit. For a few $100, you're done. Now, if you say, ooh, I want to move forward, we'll apply that $200 to $300 towards the cost of a CRT from start to finish. Now, our cost to do a CRT is $8,000 from start to finish. And with that comes all the consultations, our comfort letter, our malpractice insurance, that if we screw it up, we're going to pay the penalties and taxes. You're going to have plenty of support from me personally, believe it or not. I'm the expert in the office right now with all of our attorneys. I'm the one working on these with another attorney in the office, and my paralegals and all that. You'll get a draft of it. We're going to go through probably 6 or 8 different models to find the right percentage that works for you and your fact pattern. And you'll pay for half up front and then half once we start drafting the final documents. We can probably turn this around in 2 to 3 weeks if it's urgent. You've got a closing or a listing that you're wanting to get up on the market. Sometimes
what's the ideal? Let's say we have someone, they're not under the gun, but they are saying, hey, I see what interest rates are doing. That might tamper down buyer demand. How much lead time is your ideal to get folks to you if they say, you know what, I want to do a uni trust?
We want to turn this around in a month. So okay. In about 4 weeks, if you're responding to our emails and phone calls, we're going to respond quickly as well, and we can get this done in a month. And I've got clients that are waiting to move their crypto into their CRUT and just waiting for the next run up or bump in crypto values. And we ought to say that too, Tim. We talked about it earlier, is that you can put real estate in your CRUT, you can put crypto in your CRUT, you can put highly appreciated stock. You might be selling a business, and we want to transfer some of the stock into the CRUT before you sell. So any highly appreciated asset can go into this CRUT, and next year you could donate more to it and just build a bigger bucket.
So if you've got multiple houses, you don't have to go through this setup process every time you sell one of those. You set it up once, you have that charitable vehicle. You dump house number 1 now, maybe a few years later, you dump your second home in the ski slopes. You've got stocks that have appreciated. You can dump those assets in here and avoid that huge capital gains hit at time of sale, right?
Yeah, absolutely. Now, and let's talk about, we'll talk about annual maintenance costs here.
Okay.
In just a moment, but let's jump over to the whiteboard for one last time and just run some rough numbers here of why I think, like you said, this is just so powerful. So if you had a $2 million sale and you choose no CRT or no CRUT, it's easily going to be a 35% tax rate. Now, if you're not in California, you're going to get a different state tax scenario. But remember, folks, if you live in Nevada, but your home's in California, you're still paying California tax. So don't think about where you live. If the property's in California, you're paying California as high as 13%. So the first thing you're going to do is take this 35%, which now turns into 350,000 on $1 million times 2, because we got 2 million. So it turns into 700 grand in tax. So now you only have 1.3 million to invest. And if you are smart enough to get a 10% return on that, which if you're getting kind of crappy rent on this $4 million property, let's think about what is our overall rate of return on the value of the property, not what you bought it for. You may think, oh, my rent's great. I only bought it for 300 or 400 grand, but now it's worth 2 million. And your rent, it's disgusting. getting crappy rent on a $2 million property that you could get 10% in some sort of ETF or mutual fund. So here I'm going to get my $130,000 every year if I continue to go for it. Or I can do a CRUT and say, all right, no tax on the sale. I've got 2 million sitting there in a bucket, and I'm going to get the same 10%. Let's go compare apples to apples. And now I'm getting 200 grand right out of the gate. And you're going to pay tax on the 200 grand, and you're going to pay tax on the 130 grand. So you're not going to get out of the tax on the income. That's okay though. But what we're doing is getting this bigger bucket to play with. And now I'm getting and when you a larger paycheck, and when you take the present value of a difference of 70 grand over a 10-year period and do the future value on that and versus the present value and blah, blah, blah. Oh my hell, it's like, that's exponential. And I can asset protect it, and I can continue to grow it and invest it. Oh, and when you go, this is sweet, right? Because as you continue to invest this, you don't pay tax in it ever. You never pay tax in this. So you can buy and sell raw land, buy and sell real estate, buy and sell crypto. You'll pay no tax. The only time you pay tax is on your 10% distribution, which is going to be, so much larger than this smaller bucket over here that you're continuing to pay tax on when you go to invest it on day two. So I'm not saying the CRUT's for everybody and everybody should do this, but oh my hell, if you've got a big capital gain, peel off half of it, do some of it. Oh my gosh. I've got clients that once they catch the vision of this, they're throwing everything in it per se. I'm not saying I'd recommend that, but they're taking their stocks, their crypto and real estate and throwing it all in there and saying, I'm done. I've got my rate of return for the rest of my life as asset protected. And it just takes so much pressure off of people and the stress, and it's just liberating. And this is that American dream I love, is that you're using your finances to really create the lifestyle and the freedom that you want. So.
Awesome. So probably the last question for me, not to be a buzzkill, but it's a question that we get every time. And I think you touched on it just a little bit at the beginning, mentioning Gates and Buffett. But anytime we mention the letters IRS, anytime we say tax mitigation, and if someone's watching this, they got a letter where we're most likely talking about, hey, there are ways out there other than the 1031 exchange to have the IRS take the haircut and not you.
Yeah.
What are we looking at here? I mean, how comfortable is the IRS with this approach? How long has this been around?
From
an IRS standpoint, what are the risks here?
Well, there's no buzzkill here. We needed to talk about annual maintenance. That's where I thought you were going. I'll cover that in a moment. But oh my gosh, this hasn't even been a proposal floated in Biden's better whatever plan.
Build Back Better.
Build Back Better plan. It's a tongue twister. And Donald Trump's Tax Cuts and Jobs Act. The CRT has been protected. It's the holy grail for charities. And so the universities, the hospitals, the 501c3 community, they live on these. And so there has been no legislation proposed from the right or the left in the last two big bills that would even touch or screw this up. They've been around for years and years and years. So I mean, never can guarantee what the government's going to do, but this has not even been talked about.
If they were to do something with this, they would have a lot of very upset lobbyists on both sides of the aisle.
Oh yeah. This is a bipartisan strategy that both parties just love and cherish, and it's good for America. That it's a good thing. Now, annual maintenance on $1 million trust, you're looking at about $3,500 a year for the following services that you really can't do yourself. You've got to do a tax return for the CRUT. You've got to do the annual valuation, which has to be done by a third party, and you've got to do bookkeeping on the trust, because the trust continues to grow and invest. The character of the income you generate in the trust is the character of the income you claim on the K1. So when that trust kicks out money to you, you're paying tax on it, but of the character it was created with up in the CRUT. So if you're doing a lot of short-term capital gains in the CRUT, you're going to pay tax on short-term capital gains.
So if you're looking at things more from a trading mentality, just catching the highs and the lows of the crypto market, for instance, or a lot more short-term capital gain. If you're just one of those fire and forget folks, hey, I'm selling my $4 million home that I bought 40 years ago, and I'm not doing much else, the majority of someone like that would probably be looking at long-term capital gains characterization.
Well, the way you said it at first is correct, that if you're doing crypto trading in your CRUT on day 2, then you went to someone that was selling a home. What I'm talking about is what you do with that 2 million on day 2. So if you take that 2 million and don't do crypto, but go buy another piece of real estate or raw land, you can do that. Or you may
buy a bunch of dividend producing, safe stocks. Well, you're going to have the same characterization that those dividend payouts would.
Exactly. And so now as the value of the trust goes up, a lot of these third-party administrators, TPAs, will charge more, even though they're not doing much more work. And I hate that. This year, I'm hoping to launch my own TPA, third-party administration service for CRUTs, because you've got a $2 million CRUT, but that doesn't mean you need to pay $6,000 in administrative fees for the same work we were doing on $1 million trust. So I want to get a better pricing model for my clients in the long run. But every year you get to choose who your TPA is. So this year, the first year out, I always say, use a nationally recognized TPA, get used to the system, get used to the process, and then you could shop around. And maybe we're rolling when you choose your TPA at the outset or down the road, but you can change whoever the accountant is, for lack of a better word. Most accountants are not going to do a CRUT return or the bookkeeping for it. So you'll end up using kind of this TPA. Think of it like a 401k administrator. But that's it.
Correct if I'm wrong. The benefit of these administrators is they do a lot of complex heavy lifting just to take this off your hands so you can sit back and get the more passive experience that you probably wanted by going with this approach in the first place, vice buying replacement property.
Oh yeah. And I'm glad you said that, because I was working with a woman on a CRUT 2 or 3 months ago. She was out of Virginia. And I went through the whole thing and I just thought she was stoked and we were moving along. And she called up the next day and said, no, I don't want to move forward. I'm like, what did I do wrong? I mean, you sounded so stoked, excited about it. And she goes, I don't want this much work. I don't want to invest it. And I was like, oh my gosh, and I had forgotten. See, a lot of my clients want to continue to control the investments of this. Some don't. And so I want to mention that to many of you, that if you say, I want to sell this property and I don't want to worry about it, like you just alluded to, that's what got me thinking about it, is you can hire a financial advisor, open a Merrill Lynch or an Oppenheimer account with the CRUT and just say, invest away, just ETFs, stocks, bonds, mutual funds, try to get me a 10 to 11% return, see you later, bye, and be done with it. And some of you may want to be more actively involved in trading or real estate or crypto. That's fine. You get to choose, but you can hire an advisor to run it for you if you don't want to be involved.
Love it. Hey, Mark, I'll turn it over to Ryan here. Sorry, Ryan, I've been filibustering, but every time I watch one of Mark's videos, I learn something. Every time I read something he writes, I learn something, and I definitely learned something in this video. So from my end, Mark, thank you so much for carving some time out of your busy schedule for this. Ryan, what did we miss? Any questions from your end?
No, I'm sure we'll get the questions as we go, as we're going down the line. But yeah, thanks, Mark. Thanks for sharing. Yeah.
Thank you, Ryan. Thanks, Tim. And everybody watching, I would just encourage you to continue learning. Knowledge takes away fear, and knowledge gives you power, and it gives you options and choices. And so try not to be too critical of the 10 varieties of flavors that are out there, whether it's a 1031 to CRT or this or that. Just keep studying, look for reputable advisors. If you go out on the marketplace and start looking for a do-it-yourself CRUT you could pick up in Home Depot on aisle 9, you might have some problems, So make sure if you don't like my style, that's okay, but get a reputable law firm that is going to stand behind it in perpetuity. And that's so important to have a good credentialed individual doing this. I love working with these guys. Get your property listed, get a better ROI. People, it's all about return on investment. It's not what you bought it for, it's what it's worth right now and what you could be getting. And if you could do that tax-free and get that bucket generating better income for yourself, oh my hell, rip the Band-Aid off. The market couldn't be better for sellers. Get on it.
We'll leave it there. Thanks, Mark. Really appreciate it.